Uh, Good morning, students. So in this video, we will be looking at solving a question from chapter number 20. So this question is a question straight from your textbook, question number 24 from chapter 20 from your Fundamentals of Corporate Finance textbook. So for this question, you are given the balance sheet for the year 2014, and you're given the income statement for the year 2015, and you're also given the balance sheet for the year 2015 and 16. We don't care about the year 2016, but 2014 and 2016 is what we have. And from this information, the balance sheet of 2014, balance sheet of 2015, and from the income statement of 2015, your goal is to try and find the cash flow statement and figure out all the sources and uses of cash which happened in the year 2015. So let's go ahead and actually do that, right? So this file is available in your OWL, and it's uploaded in your OWL website. And so now that I have said that, I'm going to go ahead and actually work on this question. I'll be moving my document to my other window, so look at it all the time, and I will be referring to it every now and then. So we do have our income statement. So from our income statement, we could we need to figure out cash flow statement for the year 2015. So for this, let's first focus on the operating activities. Okay, so once we focus on all the operating activities, so the first thing which we want to look at in the operating activities, you start with the net income. Right? So the net income is $40. And to this net income, the first thing which is a non-cash charge is depreciation. So depreciation is given as $6.5 for the year 2015. So it's a non-cash charge, so you add that back. 6.5. This next thing which you have to try and figure out is try and look at all the balance sheet items. So in your balance sheet items, this is the year 2014, and you have the year 2015 over here. Okay, so let's first look at the inventory. Has there been an increase in inventory from the year 2014 to 2015? So inventory is 150 here, and in 2015 inventory is 183. So that means you've increased your inventory by 33. So that represents an increase in inventory. Increase in inventory. So this is to the tune of 33. So you spent $33 increasing your inventory. So that's a subtraction. What else can we look at? So the next item in the current assets scenario, which is a part of the operating assets, is the accounts receivable. So accounts receivable is 124 in 2015, and it was only 110 in 2014. So accounts receivable has increased by $14. Once again, if accounts receivable has increased by $14, that means you lost out on $14 worth of money. Okay, so these are all in millions of dollars, I'm assuming. Yes. So 14 million. So the last thing which you can try and think about is the increase in payables. Okay, so increase in payables. The accounts payable in 2015 is 110, and trades payable is 75. So 75 to 110. So this is a difference of $35. So remember that your payables, in some sense, when you increase your payables, you are in a sense delaying your payments, and that it increases your cash balance. So these are your net operating activities. And do we have anything else? in terms of operations. I believe in the short-term operations in terms of working capital. That is pretty much it. So once you add this, you could think of this as net operating cash flow. It's 46.5 minus 33 minus 14, 35, 30, 75. 34.5. Okay. So that's your net operating cash flow. And next we can move on to the investments cash flow. Okay, so I already have some earlier things written down over here. An older other problem, I guess. So investments cash flow, let's look at the balance sheet. So the balance sheet for the investments cash flow. So in the short term, you have the idea of bank loans and marketable securities. Bank loans would fall under financing cash flow, and marketable securities can be thought of as investments cash flow. So any extra cash, so marketable securities is $10 over here, and in 2015, marketable securities is $0. So these are investments in marketable securities. So in a sense, you have maybe sold can be thought of like investment or purchase. I think is the word more commonly used. Either the purchase of or sale of securities. So here you've sold the securities, so it results in a net addition to your cash flow. So that's $10 addition. So the next thing which we'll be focusing on is the fixed assets. So this is a little confusing over here. I like to just focus on the overall gross investments, the overall level of long-term assets before and after. So the gross investments, which is like the gross investment of assets, the stock of the assets was 250 in 2014, and it is 345 in 2015. Okay, so this can be thought of as your capital expenditure. The capital expenditure for this year is going to be, was it 250 again? 250 minus 345. And that in some sense is $95. And this is a cash outflow. Okay, so we checked off and everything from your balance sheet. You checked off marketable securities, you checked off inventory, you checked off trade receivables, we checked off payables, and we checked off investments in some sense. Okay, so now comes to the idea, the last part, which is your financing cash. Okay, so for the financing cash flow, the first thing which you can try and think about is your dividends. Has the firm paid any dividends? So here it does mention that the dividend is $30 million and the addition to retained earnings is $10 million. So dividends is 30 million. And what else is being financed? Let's look at the bank loan. So bank loan was $20 in 2014. And bank loan is $25. So you borrowed $5. Bank loan, you borrowed $5. The dividends is cash outflow, so that's negative. So in the previous scenario, that was negative 5. And long-term debt is $60 here. And long-term debt was $25. So 25 to 65. So you borrowed increase in debt. $40. And you borrowed that money, so that's a cash inflow. So what else? Now let's check the final thing, which is the net worth or the equity and retained earnings. So equity and retained earnings went from 350 to 400.5. Okay. It's not increase in shares, it's actually increase in equity or sale of equity, if you could think about it. Okay, so from this increase from 350, $10 were added to retained earnings. So it should be 360 next year if you did not sell any extra shares. From 360, it actually increased to 400.5. So that was a net increase of 40.5. Okay, and that, I believe we have covered everything over here. Covered the loans, covered all aspects of business. Interest, yes. No, interest has already been taken care of. So these are your expenses, and that's your financing cash flow now. So this adds up to what? The overall free cash flow, or what you could call changes to cash balance, is 34.5 minus 85 plus 55.5. Okay, so that's 89.5. So that's 4.5. Something which I missed. 4.5, because if you see the cash balances, the cash balance remains at 20, and it's 20 over here. So I missed $4.50 of cash somewhere. Can't think of it right now. What else did I make? Unless I made a mistake in the addition. Let me check. Increase in equity is 40.5, 400 to 360. Increase in debt is 25 to 60. Oh, there it is. This would be 50.5, as this was 35. I entered that as 40. Let's check the other values. So this is negative 85. This is 34.5. Okay, so let's add these values now. 50.5 minus 85 plus 34.5. This will be dollars now. This actually holds, right? So this, in a sense, is your cash flow projection. So you're making sure you go through all the cash flow changes. Your net operating cash flow is 34.5. Your net investing cash flow is $85, and your financing cash flow is 50.5. And so the overall changes to your cash balance is the addition of all of those. And here, that is $0. And we could also go and verify that, because your cash balance from the year 2014 to 2015 has not changed. So the increase addition to cash. It's $0. So this is how you forecast your, you calculate your cash flow statement and forecasts, and figure out the changes in cash balances. And that's it for this video and this chapter.